The gold silver price ratio, which historically traded in a 45 to 80 range, has broken out of its range since 2022. Since the freezing of Russia's reserves in 2022, gold has structurally decoupled because of the five-fold increase in gold purchases by central banks, which in the West don't buy silver.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. My name is Vince Lanci. This is the GoldFix Market Rundown. The last two trading days have been revealing in terms of who now controls the gold market, at least currently. Several days ago, with gold down $100 from its highs, concerns of an overbought market began circulating. These coincided with upcoming Asian holidays. Backtesting models, particularly those used by macro discretionary funds, suggested that following such a down move, gold tends to decline over the next 2 months. The specifics of that analysis are detailed in our recent backtest post. We will include that. Leading into the holiday period, before the China May holiday period, it became evident over a 4-day stretch that significant buying emerged in what we identified as the ledge area following the steep sell-off. Just beneath that zone, we continue to believe physical buying, likely tied to Chinese demand, remained intact. As the holiday did approach, large funds, emboldened by statistical models, began initiating short positions. However, the physical buying held firm, keeping the market in a defined range, wide, but defined nonetheless. The ledge then broke temporarily. On Thursday, the ledge appeared to crack. Singapore-based speculators, really Shanghai-based speculators, liquidated ahead of the holiday. Futures traders who had accumulated positions during Asian hours over several days exited en masse. U.S. macro discretionary funds and CTAs, U.S. CTAs, followed with their own models that signals initiating further selling. By Friday, with China largely offline, the market remained below the ledge and in a bearish posture. Still, it didn't break further. Prices hovered just below the zone we identified as the focus, or locus, I should say, of the real physical demand. The key question going into the next session was, meaning Monday's session was, starting Sunday night, was whether futures-based speculators would return Sunday evening. They did, tentatively, but enough to keep the market stable and even slightly positive. That uptick appeared to spook financial players in European hours, and the rally continued throughout the day during USA trading. By Monday evening, with Asia fully open, as we can see on the screen right here, Shanghai traders returned aggressively. As in past episodes, these are futures-based speculators, momentum-driven, well-capitalized, and well-informed. Though technically independent, they operate with full awareness of and sometimes alignment with Beijing and its proxy institutions. The market advanced proxy, sharply, I should say. As of now, gold is up $42 and change, having been up $50 about an hour ago. Which brings us to the core question. Considering that when Asia was open, the market was higher, and when Asia was closed, the market was somewhat lower, and now Asia is open again, and the market is over $140 off the low. The question is, who controls gold pricing now? Can there be any doubt that the pricing power in global gold markets has shifted eastward? Can there be any doubt that in time, gold will begin appearing priced in yuan on trading screens? Can there be any doubt that we're witnessing the erosion of US dollar dominance in gold as pricing migrates eastward, following the physical industry, which has been relocating for over a decade? Finally, can there be any doubt that the US is no longer holding sole control and must now share the stage? Goldman knows this as well. Now, we're not fans of Goldman as traders, but as analysts, we understand their work and appreciate it very much. They seem to recognize this. They've been bullish for the last $1,000 of this rally. Whether one trades with them, against them, or ignores them, they've been correct, which brings us to the second key point. Goldman's Sunday night note. In it, Goldman reiterated their bullish stance on gold remarkably during the rally. More notably, they stated they expected gold to outperform silver in the coming months and laid out their rationale. We neither endorse nor dispute their view here. We simply note it, and we will cover it in a minute. An excerpt of that report is included. Before we get into that, let's go through the markets so you can look at the gold market while we're doing that. 10-year yields are unchanged, offered at 434 and change. The dollar is 99.54, down 23. The S&P 500 is 56.10, down 39. The VIX is 24.63, up 98. Gold is 33.74, up 40. Again, over $140 from the low of Shanghai's close. Silver, 33.02. Not overperforming like it usually does, but overperforming relative to where it did yesterday. I think we're setting up for something here. Copper, 465, up almost nothing. WTI, 58.53, up $1.11 after swooning yesterday. Natural gas, 346, offered unchanged. Bitcoin, 93,800, down 900. Palladium, 950, up 8. Platinum, 976, up 14. Gold, silver, 102. There are new players in this market now trading this spread. We'll touch on that in a minute. Soybeans offered down 3. Corn, 447, bid up 1. Wheat, 535.90, up 3 and change. There's our homepage. Content has been light. Hopefully your email box is taking a break and appreciating that. We're aware that we have been sending more emails than usual lately. Top center, breaking gold up 72, gold up 93. That's a continuation. The morning report yesterday is there, and the afternoon report yesterday's top left. And then lower left, you see the Goldman gold to continue out glittering silver. We're going to touch on that now. We're also going to go through the price action decoded. Gold breaks out, soars $145 in 8 hours. That's what's going on. China is in charge. Can there be any doubt? Okay. So Goldman put out a report Sunday night for East Coast US people, Monday morning for London, and it reiterated their comment about gold going up and actually said it was a good level to buy. This coincided with, at the same time, coincided, that's the definition of the word, this coincided with a big ramp up in gold buying coming out of Europe with dollar selling and silver selling. The silver selling peaked at about 9 a.m. US time. The point is, someone is taking Goldman's report to heart. And while it's not new, it's worth noting because it's something that's never, ever, ever been discussed publicly. And outside of this space, no one talks about it. In fact, no one really identified it as a reason for silver to go down when gold goes up. But here it is on display for everyone to see. Unfortunately, Goldman, gold to continue out glittering silver. Quote, we believe this is an attractive entry point for a long-term gold exposure. Speculative positioning is light and has significant room to rebuild. In the latest missive from the Goldman Sachs Precious Metals team, headed by Lena Thomas and Dan Stuyven, they weigh in on recent calls for silver to close some of the distance with gold. Here is that analysis broken down for premium subscribers. Here's an excerpt for you. The gold-silver price ratio, which historically traded in a 45 to 80 range, has broken out of its range since 2022. Since the freezing of Russia's reserves in 2022, gold has structurally decoupled because of the five-fold increase in gold purchases by central banks, which in the West don't buy silver. There are plenty of points to this, and all things that have been touched on here in the past but they make the case without saying it to buy gold and sell silver. And you'll note that yesterday gold was up 2.8% and silver was up by relative measures a paltry 1.2%. We believe that funds that had been doing it before, we've talked about that here in the space. Funds buy gold and sell silver when they think there's a recession or when they think they want to hedge the base aspect. Many, many reasons for that, many such cases. In fact, last week we just talked about that. Interesting that Goldman writes that. Anyway, we believe if you're looking for something to hang on, we believe that this is how crowded trades start. Now, we're not telling you it's going to happen tomorrow, but right now there are big macro funds that are selling silver and buying gold, and they will continue to do so until they decide to either cover it, which will happen on a big washout in gold, or in a big rally in silver due to physical demand outweighing paper shorting. In short, I guess what I'm saying is that gold macro discretionary funds are now doing what CTAs usually do, and they do it bigger, and they stretch things a little bit further before they cover. In the end, this is how crowded trades start. That full analysis, that full Goldman report excerpt is at the bottom of the report where you can click on the link right there. Next up, today's data on deck, 8:30 a.m. U.S. trade deficit in March is due in at minus 136. Keep in mind the trade deficit was exaggerated depending on how you measure accounting because gold was counted as a good purchase, but it did not help GDP. Depends on how you look at things, but the world is changing in that respect. Related post to the topics today, gold is up $93. That was yesterday. Breaking gold up 72. And special, there's the China gold selling decoded why they were selling. Today, we're going to finish up, wrong page. We're going to finish up by going into the price action from here on in, looking forward a little more tactically. So let's do that now. So there's an hourly chart. Let's back out to a daily. Now, let's stretch this out a little bit for everyone. On this day, April 24th, we identified and shared with readers based on a couple things, one of which was the Commitment of Traders report, that there was a pattern reemerging, and that pattern was dive off the high and then for no apparent reason stop, and then you think a ledge would form and the market would roll over, as gold historically has done that. However, having been fooled in 2024 in this configuration several times, I noted that there was buying here, and the buying was bullion bank and short fund related buying. However, a couple days go by and you have this buying here. And my suspicion was that physical buying was down here. You have a couple days go by and the market starts to work its way lower. And then you have the Shanghai traders puke. And when they puke, as Goldman noted in another report we share with everyone, when they puke, American CTAs saw that and sold as well. Macro discretionary, who had been looking at the statistical analysis about gold making a new high and then coming off of it, being ripe for a 2-month retracement, also sold. So you have, and again, it's after the fact. I didn't see this one beforehand. But what you have is you have a fish hook here, because on this day, the day by all rights, gold should have just crapped out. It should have dropped. And it should have dropped because China was fully closed. Macro discretionary was fully bared up. And American CTAs were due to sell and get short if the market were to continue lower. But it didn't. And that's because, well, I think we were right. China's Shanghai traders may be on holiday, but the physical demand in here remained. So the market didn't go anywhere. And sure enough, Sunday night, gold opened, rallied, again, tepidly, but on a tepid rally, when American macro discretionary doesn't sell it, that means they want to cover, admittedly, in retrospect. Europe, it was bought. America, it was bought. A little bit of a pause between, say, 10 and noon. And now we are here today, and China is back in full force. We said on Sunday that below, we can get rid of this line now. We don't need it. We said on Sunday that below this line, you were bearish. If the market went back into this line, you were mildly bullish and you would buy call spreads. And then we said if it gets above this line and expected it to get to that line, 2 days is pretty quick, to be honest with you, but we expected it to get to that line. Then the market is definitely bullish and you would be longer with an eye on the market settling back into this line. Now, why do we say that? Because, taking a little of a drawing tool here for you all. This was Chinese buying. This was related to Singapore buying, meaning not Singapore, Shanghai buying. And this was macro discretionary selling it because they read the report that said after this, the market goes down. So they sold it, 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 they sold it. Okay? We got up to that level where most of them got short and they covered. Now that they've covered and the market is above all these levels that they sold before, all that remains is this area. We are fully able to test this area, I'm sorry, a little bit higher, without any contention from the market. So the tailwind is Shanghai being open. The impetus would be if the macro discretionary boys who sold it here reverse and get long. And they are apt to do something like that. I'm not really sure if it'll happen. But that's the behavior. That's what happened during this time frame. You can take that to the bank. Again, you're bullish above this line. You're neutral in this line, especially if we get back into this line. Now you think maybe we retrace all the way back down to the bottom. You can see my dotted line there. That's my last alert. I'm not bearish until we get below there. I was short call spreads. I butterflied it yesterday as per my own advice. I took my own advice, Scott. And then I took a call off on the close. So now I'm basically long call spreads. So we'll see how that goes. Fingers crossed. Let's zoom out a little bit so you can see that on an hourly basis. Okay, so here's Friday at 11. Here, I'll put a drawing tool up there again. All right, so here we go. Sunday opens and gold rallies. Where am I? There we go. So Sunday opens and gold rallies from the get-go. Then you have a little bit of sell-off, no big deal. Then the market starts to ramp up headed into Europe. Europe opens, and that's your fund buying. That's your macro discretionary funds covering shorts. Market does a little bear flag during the day, hourly. Europe closes right here, and the market, this behavior starts again. Same behavior as this. And then the market tops out at 33. It's interesting that it got above 3,300, and then the market just, where am I? It got above 3,300, and the market just took off. So here we are again. Asia opens, and it's nothing but up, right? A little bit of a profit taking, and now here we are during American hours. Now, what did I say the other day about American buying? American buying now comes in at around 4 a.m., and that 4 a.m. buying is representative of what they think is going to happen in the U.S. As long as stocks are lower, gold's going to catch a bid. So as long as stocks are lower, look at gold to outperform silver. If stocks are higher, you may see someone get spooked. But that's it. I'm Vince. This will be the last email today, except for the one going out to founders. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.